This is from the second largest producer of silver in the world, who's been flying all around Latin America for the last couple of years, buying doré and concentrate from Mexico and Peru, number one and three. So the number two producer in the world buys doré and concentrate at double what the West will pay from one and three, and then is importing more silver than ever in recorded history after the price got destroyed. Price is a tool of misdirection, is the moral of the story. The price will throw you off the trail. The price will throw the media and the talking heads off the trail. And the financial advisors, you're crazy, Mr. Jones. Why would you ever buy that stuff? Look at how poorly it's performed in this atmosphere. But then the money over there says, shh, and they're scooping it up like this while everyone else is being misdirected by price. That is the kind of stuff that to me is all you really need to know. If you have the ability to separate reality from emotion and say, yeah, really? If price was that big of a hindrance, then why do we see entities across the globe doing what they're doing to accumulate it?
Another important issue to understand is something called rehypothecation. This simply means that the same asset can be promised to multiple people at the same time. In highly leveraged systems like commodities or private credit, this creates risk because everything works fine until trust starts to break down. Once confidence drops, liquidity can disappear very quickly and markets can react suddenly. Andy Schectman compares today's environment to past situations where too much leverage caused sharp disruptions. In those moments, gold and silver tend to stand out not because they are used for everyday transactions, but because they don't depend on anyone else's promise to hold value. They are assets you can own outright without counterparty risk. And this doesn't mean a financial collapse is guaranteed. Instead, it points to a slow decline in trust across the financial system. As markets become more complex and more dependent on digital and paper-based instruments, many investors are starting to appreciate the simplicity of physical assets. Gold and silver, in this sense, act like insurance, something you hold quietly for protection, not something you constantly trade.
Yeah, it's not that you're going to need gold and silver, God, God forbid, to buy food. But what it does mean is that we've reached a period of time of leverage, and this could never happen here, where, as Doug Casey has made famous, the statement that gold and silver are assets that are simultaneously no one else's liability. It's true. And in a world of diminishing privacy, in a world that is dragging us into the digital surveillance state through a digital ID and ultimately the Genius Act digital money, is there anything wrong with being old school and being analog in a world that is highly digital? My answer is absolutely not. Clinging on to those virtues of privacy, liquidity, um, I think there's a lot to be said for it, but it's not, you don't have to let your mind go to the Stone Age where we're bartering with gold. It's not about that. It's more along the lines of getting away from this inherent risk of leverage and the unwinding of leverage that, when we talk about how leverage built this up, when you unwind leverage, it has a far greater multiplier because leverage on the way up is not all at once. Leverage on the way down is bang. Everyone sells at once,
Right.
freaks out, and it's more magnified. So yeah, I think that's what it's about. Yeah, that is exactly what it is. It's also ironically happening in similar scale at the exact same time in the private credit market, where again, it all boils down to trust, lack of trust, trust of our institutions, trust of our markets, trust of our political structure, trust of everything. And yes, that is exactly what is happening. That's why people tell you there is no really there's having physical possession. It eliminates the counterparty risk that is growingly pervasive in everything these days in markets where you know old rules don't really apply as much as they were. And all of these things, whether it be a run on Comex or a run on the banks, are reminiscent of one thing, a Ponzi scheme. A Ponzi scheme where you issue more paper than there are bars
Right.
or
More
shares
more
of a
more claims
certificate.
than actual
Yes,
collateral.
yes,
Yeah.
and that's exactly what it is across the board. Or you leverage yourself too much in private equity and sell it based upon liquidity that when everyone comes at once, it doesn't matter what market you're talking about. If it's over leveraged or or rehypothecated. When everyone comes at once, you have a problem. Well, that's why they say there's no bull market like a precious metals bull market, because in equity markets, you make all this money and you take a bunch off the top, and you go back into dollars and think about what you want to buy with your profit, or buy more stock. In a metals bull market, it is one that is predicated on concern and fear. And the higher the price goes, or the crazier the world gets, only motivates you that much more to trust and believe your intuition that led you that way to begin with. You're not selling it and going back into dollars in this system. It's one of these things that can happen relatively quickly. I think the first thing that you would see in that environment in relation to this industry would be, a lot of backlash in countries like Australia, South Africa, um, Great Britain. Why the hell are we, especially probably Great Britain these days, why the hell are we sending the US our stuff? Why would we send them our stuff
Hmm.
um, when we can keep it here at home? Why would we ship it across the globe? I think you'd see sovereign mints stop shipping into the United States, probably pretty quickly. There would be no reason or incentive to do so. And yeah, I think it would be, because at that point you start to see a rush to buy it, and then you buy future production. You're buying everything you can, and the big money certainly would lead that charge. And this is an industry that I've seen, look, there's never been anything like we've seen in the last 5 years in this industry. I remember many, many years, though, where there had been disruptions within this industry in the 36 years I've been doing this, that were, little microclimate instances along the way where bang, just like that, something happens and everything is gone. Like in 2008. In 2008, in like, everything's normal, 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 normal. And then bang, the price of silver goes from 21 to 9, and gold goes from 1,000 or 12,000 to 700, I think. And this is, you would think in that environment, when silver just fell by 60% and gold by 30% in a matter of days, that there's no demand at all, that everyone is dumping supply as fast as they can get onto the market, but couldn't be further from the truth.
The precious metals market is undergoing a subtle but significant change that many investors are still ignoring. Deeper signs indicate that something far more important is happening behind the scenes, even while price moves in gold and silver continue to appear erratic and uncertain on the surface. According to Andy Schectman, president and founder of Miles Franklin, recent price declines, especially in silver, are not a sign of fading interest, but rather a strategic illusion. He argues that while Western investors often react emotionally to falling prices, major global buyers are doing the opposite. They are accumulating physical metal aggressively, taking advantage of lower prices to secure real assets while sentiment remains weak. This growing disconnect between paper pricing and physical demand is becoming harder to ignore. Massive amounts of gold and silver are continuing to leave exchanges, signaling that more investors are choosing to hold the real thing rather than rely on paper contracts. At the same time, international demand, particularly from Eastern markets, remains strong, even increasing during periods of price decline.
Bear with me one second. But the short answer before I find the actual numbers is yes, we absolutely are seeing the exact same thing. The numbers are increasing, unabated, as a matter of fact. So let's see here. In first day notice for April deliveries showed that 10,138 gold contracts stood for delivery. That's 1,013,800 ounces of gold, and 1,181 silver contracts. That's 5,905,000 ounces of silver were posted for delivery. And, if we look back at the March numbers, Adam, we see there were 14,559 gold contracts delivered, which obviously a lot of gold, 1,455,900 ounces, and 9,212 silver contracts, 46,060,000 ounces. This is the question that, in my mind, has been missed completely and totally by the mainstream. These are not trivial numbers. You're in the billions and billions and billions of dollars every single month. A lot of it leaving COMEX. A week ago, Friday, I believe we saw 2 million ounces leave the eligible category. Those aren't even for sale. Those aren't even bars that are posted. That would be like someone taking 2 million ounces out of our storage program in 1,000 ounce bars, which is an eligible category, Brinks JFK, New York, and taking physical possession of them. So, how much does 2 million ounces weigh? I mean, I'll ballpark it for you. You're looking at, geez, uh, ballpark, uh, about 168,000 pounds. So, when you realize that in February we talked about almost 39 million ounces leaving the COMEX, getting on trucks and going, that's over 2 million pounds. So, yeah, it's continuing unabated. You look at what happened for not just here too, because you look at what happened in February after the price of silver literally got its teeth knocked in. China recorded its largest single monthly inflow of silver ever in recorded history. January and February combined were off the charts. February was the biggest single month ever. Now, this is from the second largest producer of silver in the world, who's been flying all around Latin America for the last couple of years, buying doré and concentrate from Mexico and Peru, number one and three. So the number two producer in the world buys doré and concentrate at double what the West will pay from one and three, and then is importing more silver than ever in recorded history after the price got destroyed.
In the end of the conversation, Andy Schectman says why a rising lack of trust is a significant problem in the current financial system. He notes that confidence plays a major role in a number of industries, such as private credit, banking, and commodities. Because so much of the system is based on promises and leverage rather than actual, tangible assets, issues may spread swiftly when that trust erodes. He cautions that there are more claims to assets than there are real assets in many places. This is only effective if no one tries to demand delivery or withdraw at the same moment. However, in the same way that a Ponzi-like structure collapses when too many people attempt to cash out at once, the system may struggle to operate if confidence is lost. He stresses the value of actual gold and silver for this reason. You eliminate counterparty risk when you own them directly because you don't rely on a bank or other organization to provide value. He contends that having actual, tangible assets provides a sense of security and independence in a world where financial institutions are growing more intricate and digital. Schectman also believes that if a strong bull market in precious metals begins, it could move very fast. Unlike stocks, where people often sell when prices rise, rising gold and silver prices can actually attract more buyers who want to protect their wealth. This can create a powerful cycle of increasing demand.